1. Hi, and welcome to From the Research Chair. This is episode number 19, the top 5 accounting mistakes that research analysts make. I'm Jason Voss, and as always,
I am Michael Falk.
So thanks so much for joining us today. We're going to do a slightly different format. Michael received his second COVID shot this week, and he said, I need a topic where I can be sort of interviewer, and we leverage your strengths, Jason, just in case I'm loopy from shot number 2. Michael, I'm going to turn it over to you.
Well, let's be specific. I got it yesterday. I didn't get it earlier this week.
Oh, okay. All right. Well, technically still, the Venn diagram there is overlapped, right? One subsumed the other.
I'm just wondering if I could be a little more snarky and get forgiven.
Sure, of course. So I'm going to turn it over to you. You're going to sort of, I think, interview me on this subject. I have my master's in accounting in addition to finance, and this is a special fetish of mine. I'm still a old school financial statement analysis guy.
So I should just declare at the outset here is Jason, with that background, is one of my most favorite geeks in the industry that I've ever met and had the pleasure of working with. So with that said, Jason, why are you so passionate about this topic that we want to bring to our listeners today?
But, it's a good question. I think when I was a pup in the business, going back almost 30 years ago, I was fascinated by the idea that insights could be gleaned from the accounting. I think my skill set's naturally like that of a detective, and the idea that you could bring right brain skills like contextualization, like identifying through intuition, pursue this line of inquiry, not these others, and then bringing that to something as hardcore and as fixed as accounting was super interesting. Then, as a research analyst, I started to learn and a feature in some of my answers today, I'm certain, that they're actually indicative of the underlying behaviors of management. And I wrote about that in Return to the Active Manager, my co-authored book with Tom Howard, that one layer that you can bring to financial statement analysis that most people don't is the behavioral layer, because these are outcomes based on decisions made by management, and they are indicative of underlying behavior and bringing that. So I think I've always been fascinated by behavior, and I've always had kind of a detective's mindset. So I think that's why.
Interesting. I've always looked upon numbers as the cleanest, most honest language that we have. But to your point about the behavioral side, how are those numbers used? How what appeared to be crystal clear fact, how is it being used to tell a story or a narrative, if you will, Jason?
Well, that's in fact one of the primary concerns that I highlight when I talk about financial statement analysis as a consultant, and that is that they are most powerful when matched to narratives and over time, because of the indications of behavior and because of the fact that people, management, are expressing themselves and their likely direction of the firm based on strategies and their ability and competency at executing business plans, et cetera, and then the natural outcome baked in the numbers. So that's one of the mistakes I see. That tends to be a sort of early career mistake, is that people are reading the numbers and doing the analysis on it in a vacuum, and they haven't brought in the narratives to see if they match. And when there's discord there, it leads to two sorts of aha moments. One, I need to call management, talk to them about what's going on. Why don't they match? Or two, the aha moment is can be a good thing too, which is I now understand the business more comprehensively, and it may be that they're not distorting or lying about the numbers. It just may mean that they're shite communicators in terms of the narratives. But either way, when those two things are simpatico in alignment, that's usually a good thing. And when they're not, it's also informative.
Yeah, we cannot all become the drunk who dropped their keys in the field, but yet was looking for the lost keys underneath the lamppost because that's where the light was, right? We have to connect these numbers to the what we believe is the reality of the business. So Jason, with that introduction, if you will, why don't you've got a few enumerated mistakes or errors of judgment, if you will. Why don't we kick off with the first one? What is your first issue with the errors that people are making in terms of the accounting side of the equation?
Yeah, and these five, it's funny. I've had many conversations over the years. Some people have their own favorite five. These are my favorite five, born of one experience as a research analyst, then as a PM, then as a partner at a firm, but then also serving as mentor for a team and trying to help them get better. So my number one, and it is my number one, even though it will seem perhaps tame.
Not 1.1, but one.
Yeah, number one, the use of generalized financial statements. And what I mean by that is frequently in the business, we use the statements downloaded from FactSet or from Bloomberg or from Yahoo Finance if we're a graduate student, or from Cap IQ or from some sort of system. And the reason that bugs me is for the following reasons. One, it tends to smear. That's a technical term. Smear meaning because the human beings, formerly, now machines that have been programmed, are aggregating things to improve comparability between firm A, B, C, D, so on and so forth. And in so doing, though, they remove quite a lot of detail that I will say is very qualitative, that helps with tangibility. And I'll pause in just a second. Tangibility is why this is a big deal. I think that when the data comes alive for the analyst, that's when all of a sudden everything starts to click. You can match it to narratives. You can ask better questions, et cetera, et cetera. Your follow-up questions.
So Jason, if I'm hearing you correctly, and I think I am, that means that people who use from FactSet, from Capital IQ, from Bloomberg, they download these, they use these, that they need to stop it, and they need to actually go to the source material, annual report, if you will, and they have to build these themselves. Am I hearing that correctly?
You nailed it. And the team of folks that used to work for me hated me because I used
Shocking.
because I used to make them hand enter the data, which I did myself as well. And you can do that when you're a low turnover shop that runs a concentrated portfolio like I did. But the reason why, again, is for tangibility. And initially analysts would bulk, right? We had access to FactSet and to Bloomberg and to Cap IQ. We had access to all of those systems, and they would download, and I would say use them for what you can use them for. Comparability is great. Screens are great with those things. What's not great is understanding necessarily. So I'll give you an example. One business's net revenues compares to a company in the same industry, customer sales. That nuance tells you already something about the business that otherwise is smeared when you're using downloaded statements. The customer sales company clearly is focused on the customer as client, whereas net revenues is a little bit more dry, as an example. Secondly, there are a lot of one-time items. More technically, one-time items that get hidden and aggregated in a single line, typically in those aggregated statements. And then the act of actually hand entering the data, because memory is one of the things that I study, because I study things like meditation and creativity and the neuroscience of decision making. The more senses engaged when learning something or about something, the easier the recall. You have a much higher likelihood of being able to recall that in context when needed if you do another sense. So tangibly doing this with your numeric keypad helps that tremendously.
So your
yes.
admonition would be as simple as 3 words: do the work. But hold on here. So when we're talking about doing the work, Jason, what percent, hazard a guess, what percent of financial analysts are doing the work, in your opinion, today?
Not enough. And that's a safe answer, only because I recognize some of our
That's
clients on
so
this.
disappointing.
All right, in full candor, you and I have had this conversation offline before. Not most, right? So
So we go from not enough to not most. I think our audience,
is
they're sending me
disappointed.
notes. They're sending me notes from a psychic perspective. They'd like to hear a number estimate.
I think people will actually roll up their sleeves and do the nitty gritty of financial statement analysis, given the full, and here I'll establish good context. The entirety of those who are active managers, the percentage that actually do real financial statement analysis, 15%.
Okay, all right. So thank you. Thank you for providing a number.
That's a
All right,
guess.
let's move on.
Hold on, before we
What is
move
your
on.
second?
No. I have 2 points on number one.
I'm in charge of this interview.
But there's an anecdote that will make number one more clear why it's important.
So
So
15.
GP, not general partner, Michael, Mr. CIO, Mr. former hedge fund manager, GP, Georgia Pacific. So if you hand enter your data, you learn the
So
following.
we've really devolved talking about toilet paper now.
Well, it's COVID era, of course, so we have to. No, GP, Georgia Pacific. So years ago, hand entering the data, I entered the revenues for the most recently published quarter from their 10Q, came across the news wire, started entering it, then cost of goods sold. And the question is, if you hand enter your data, how do you ensure data accuracy? Well, you build in formulas so that, cost of goods sold less revenue should equal gross profit. It didn't in GP's case. So GP's GP, gross profit, didn't match that number. And I picked up the phone, called the investor relations person at GP that was my contact there. I'm like, I can't get your gross profit number. And he's like, what? That's ridiculous. It's on page whatever. We just published the report. I reviewed it today. I'm like, okay, tell me how you get that number. And he's like, well, it's right there. And I said, no, calculate it. And I hear him pull out whatever, probably an HP, whole other discussion. And I hear him type away, like, you couldn't get their cost of goods sold number. It was inaccurate to the tune of about $70 million. And that error, because I tracked it, was carried through forevermore. Nobody ever corrected it. They didn't issue a corrected statement. 70 million to the positive. I don't know how it ended up there. You know that if you hand into the data. You know that because you did the calculation yourself to see if you could get the number. You know that because it's tangible. So that's an example of why that's powerful.
All right, so we're about 1/4 into our time, and you have only covered 20% of your.
We'll get there.
Number 2 on the hit list, Jason.
Yeah, this is actually probably my favorite one because of my detective's mindset, and that is the lack of understanding of the reflexivity and interactivity of financial statements. So most people, in my experience in working with them, read them in isolation. So there's the profit and loss, or the P&L, or the net income, or the income statement. Then there's the balance sheet. Then there's the cash flow statement. If you're really tricky, you'll do the consolidated statement of equity. And then, of course, the footnotes. And most people, in my experience, don't understand things as simple as if a change in accrued expenses happens, which income statement account does that affect? They don't necessarily understand that. And because they don't understand the reflexivity of it, games are played by businesses in doing their reporting that allow them to sort of get away with some tricks. And I'll pause there. I bet you have a follow-up question, but I have a couple of anecdotes here.
Well, part of this potential sinister behavior, and maybe that's too strong a word, is claiming success in their operations that is really little more than financial leverage.
It can be, for sure. It can
and
be, sure.
Wow, wouldn't we like to know whether the company's, think about it. If a company is growing their operating profits without financial engineering, you know what? There's a good reason to believe they're going to be able to continue to do that to some extent. But with the financing and the leverage side, so when you're going through those differentiated accounting statements, we need to pull them apart a bit, don't we?
Well, absolutely. In fact, I was just interviewed by Prague Finance Institute about my favorite valuation metric this past week, ironically enough. And I had said that it is market capitalization to net income. And they asked why. Right? I've never seen that before. And I said, because of financial engineering. I said, everybody looks at a PE ratio, but the EPS number is not a good number because it's not really about performance because of share buybacks and options issuance. And there's that EPS number is absolutely in control of the company, which by the way, is if a company ever reports a missed EPS, either they're massively failing as a business or they're truly an honest firm that's not playing those games. And one of the insights going back to number one, not hand entering the data or using generalized statements that I came up with in my career was the income statement has different C-suite ownership depending on where you are on the statement. So above operating income up, you have the CEO who's setting strategic direction, the COO, Chief Operating Officer, responsible for that. Then you have the CFO below that, and you can evaluate the quality and performance of each of those C-suite executives from the income statement. When you hand enter the data, this becomes very obvious, these distinctions, and the document was originally set up for that. Going back to number two, though, not understanding the reflexivity, there's a fantastic book written by a guy named John Tracy, How to Read a Financial Report. He subsequently, I think, retired, and his son has sort of become the inherited author. I've never seen such an arrangement before, though maybe Jim O'Shaughnessy, right? His son is now writing O'Shaughnessy stuff, right?
His son is now in charge of the firm.
So there you go. He's doing the writing. But John Tracy's son wrote this book, and he goes through line item by line item in an income statement, balance sheet, and cash flow statement, and uses arrows and discusses how everything interrelates to one another to be able to learn how to do this. And then I have one other comment.
So that is a strong recommendation for those interested in financial statement analysis on this call. Name of the book and the author again, Jason, just in case people didn't mark it down.
Yeah, How to Read a Financial Report by John Tracy. So the tip I want to pass on here for folks, if you haven't done this, we sometimes learn this in our accounting classes in undergraduate or graduate education. I don't think CFA Institute in their curriculum does this any longer, but build indirect and direct versions of the cash flow statement based entirely on the income statement and the balance sheet. And you can start to see some of the gimmicks and games that companies play. The indirect and direct methods ought to come up with the same number. They don't always.
I'm worried at this point, Jason, if we don't move on to number three, I'm going to have nightmares tonight about some of my formative years of learning about this material.
Tell me about your nightmares. I want to hear about nightmares.
Oh, no. See, the accounting side. Well, we're going to finish on some of those topics today for fun. Got to have a little fun, even though we're talking about accounting. But this doesn't mean fun with numbers. Jason, number three on your hit parade.
Number three on my hit parade is something I reluctantly talked about way after I had retired from being a portfolio manager. And that is to notice, and others have noticed this as well. This is not my original thinking. I mean, it was original in the sense that I didn't read somebody else doing this and I decided to do it. Other people have had the same realization.
Oh, just tell us what it is already.
Each of the three major statements is on a different temporal dimension. And people don't often put them on the same temporal dimension. And consequently, again, there's information used by companies that is smeared. And I have a really good anecdote for you, which led to a quick and rapid sale of a business I had held for 3 years at the time. But for example, the income statement, quarter one, it's an accurate reflection of the quarter. At the fourth quarter, the annual statement, it's an accurate quarter of the 4 quarters total, but thereafter it's aggregated. So the second quarter income statement is the first 6 months, the third quarter is the first 9 months. And if you want to see the individual quarterly performance, you actually have to subtract the other quarters from one another in order to isolate. Same is true also for the cash flow statement. Very few do that though.
So we're accumulating an issue.
We're accumulating an issue. And
so we need to de-accumulate.
Exactly. And by the way, then you could do some kind of cool stuff. Once you've disaggregated and they're on the same temporal dimension, one, you get transparency like you've never seen before, which I'll give a great example of in just a moment. Same one as before that I alluded to. But then in addition, you can do a really cool thing in your valuation models, which is you can do a rolling 4 quarters analysis, which serves as the basis for your ongoing valuation statement. Because everything's on the same temporal dimension, you can simply add the previous 4 quarters. For the balance sheet, you just average, because the balance sheet is accurately reported each quarter as a snapshot in time. So you can just take the average of the previous 4 quarters. But anyway, that I think, and this is a guesstimate totally, I think that improves valuation models in terms of their accuracy by 5 to 10%, something like that, being that doing that technique. But
Well, hold on, 5 to 10%. So let's just take the bigger number just for grins. I'm not going to use the other word that goes with and grins. 10% plus or minus would be a 20% boundary or range in terms of correct valuation. Jason, when we work with teams, how often do they have that 20% range above or below?
well, they don't. And by the way, see Michael's in my previous dissection of most misunderstood investing topics. We talked about fair value, and most people don't do the above the target price range. They don't really have a valuation range. They typically, margin of safety means the listed price, and I try to buy 15% lower than my estimate of fair value, but they don't acknowledge that they may also be underestimating and have an upward range. So Michael and I find in our consulting work that frequently people sell too soon once the quote unquote target price is achieved, which is an error in judgment.
Which takes me to my first major point today. Yes, I know I took 24 minutes to get there. All right, here's the point. As I stated before, numbers are a clear, logical, beautiful language. But we as humans don't always work in a clear and logical form with our own use or how we hear language. When we focus on the math in the financial statements and do the analysis, beware. Be careful. Be suspect of how the numbers are gaining your confidence and trust. Point to never forget. Numbers gain our confidence and trust. Be careful. Jason.
So yeah, my anecdote, and yes, Michael, I totally agree. That is a mistake made frequently by younger analysts, is that they, because of the certainty of numbers and because frequently our learning of numbers is in either mathematics or like the physical sciences, talking about, primary school education, we lend them a credence that we should always question, which is one of the morals of our story today. But in any case, my anecdote. So Crown Castle International, I didn't used to mention these firms' names, but hell, it's been 20 years. I can now do it. Crown Castle's still around. For those of you who don't know, it's one of the largest owners of cell towers globally. And they did an acquisition of a portfolio of BBC towers in the UK to grow their UK presence. I think the year was circa 2000, 2001. I can't remember exactly when. And this is why putting the statements on the same temporal dimension is important, as well as matching numbers to narratives is important. So there was a huge narrative in sell-side research about cell towers of who would be first to be cash flow positive in the business. Ergo, they're managing their portfolio better. They have a portfolio of better assets, more appealing locations for these towers. And consequently, there were bound to be valuation boosts to this, or a boost to the stock who did it first. Crown Castle was the first. And so they printed cash flow from operations positive, I don't know, first quarter 2001, again, I can't remember the year exactly. Second quarter also reported positive cash flow. But what was weird to me is if you understood how their business worked, this is the narrative part from number one, in terms of accounting mistake, the more antennas you add on the towers, they are almost 100% cash flow accretive, because the expense is basically, I've got to install this. So if you didn't do any major acquisitions in the quarter, ergo your sales department was selling like mad, more leases to the cell companies themselves, why didn't cash flow double? And it didn't. It just barely went up. It just squeaked up. That was really mysterious to me. I saw that because of disaggregating the statements on a temporal dimension, that the cash flow from operations barely ticked up second quarter from first quarter. I called Ben Moreland, who was the CFO at the time, and I asked Ben, hey, what the hell is going on here? This doesn't make any sense whatsoever matching the narrative. He said, oh, I'm going to go investigate that. He called me 2 weeks later with the controller on the phone, as well as their counsel. And what they had done is they had, through their buddy system with the BBC and having acquired these towers, they delayed, because they did a sale leaseback, the BBC, on these. Crown Castle had gotten special disposition to delay their lease payment from March 31st to April 1st. Oh my God, look, here we are all these years later on exactly the same day. They delayed their lease payment by 1 day, so they were able to print a huge cash flow from operations quarter one. Quarter two, the sales department had kicked ass. They had done a whole bunch of sales, because even incorporating their huge monstrous lease payment to the BBC, they were cash flow positive. Needless to say, we sold Crown Castle.
Number three.
Number four, my friend. That was apples to apples, temporal dimension.
Temporal. I'm so sorry.
Number four.
This is why you've got to stay more succinct. I'm losing track within 5. Trouble with numbers. Number 4, Jason.
And this one's classic, adjusting for distortions, right? Every accounting textbook you read says you should adjust for distortions. Very few do. And of course, we're talking about non-recurring items, pre-tax versus after-tax effects of those various things. It's a pain in the ass. Some services do it for you. It's nice, but it's still, I would argue, has value add. I still, in my private investing, do that, and I still notice things and games being played. Another tip, look for round numbers. That one I'm stealing from Securities Analysis on Wall Street, the 5th edition, which is my favorite of the editions, in which they said, beware of round numbers like 50 million, 75 million, or the non-recurring and one-time items, because that is perfect evidence that that is an estimate on the part of management, and that number is going to change in the future. So you need clarity anytime you see a round number.
See, you use the word estimate, and I don't know why, Jason, I cannot get the word plug out of my head.
I think you're right to use that word.
Well, so you're being overly kind.
I am.
Yes?
I am being kind. I mean, they're required to make an estimate of future one-time and non-recurring, but let's just say 75 million, 50 million, 80 million, 100 million, 110 million. When you see a round number like that, you know there's not a real, guess what, numerical calculation behind it, Michael.
Yeah. And you really, you don't need a calculator for these numbers, do you, Jason? Because when we're working with, just how many decimal points and zeros do we have, we usually can do that math in our head. Isn't it interesting? If you don't need a calculator to figure this out, maybe don't look any further and don't invest.
That would be my argumentation. So this tip, the adjusting for statements, if you match it to some of the numbers up above, like hand entering the data and considering each number that you hand enter relative to the narrative, you also notice that there are very many mischaracterizations of accounts. I especially see that in the cash flow statement. I see many things expensed as cash flows from operations, as cash flows from investing or financing, when in fact they ought to be in operations. And by sleight of hand, the CFO, and with the checkoff of the auditor, accounts that should be rightfully operations show up elsewhere. And I catch that mistake, I'd say a couple times a quarter in my work still to this day. So that's another reason you want to adjust for distortions. It's not just the ones that are reported on the income statement and then in footnotes. It's the actual distortions, meaning, is this categorized properly? And so that's the other distortion you have to look out for.
I think we've gotten to number 5 before I start to weigh in a little bit. Number 5.
Number 5, footnotes, 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 footnotes. Everybody says footnotes. However, I don't know that a lot of people on the call, they read the footnotes, but do you take the information that's in the footnotes and build them into a more comprehensive set of financial statements? As an example, the inventories, many firms that are manufacturing oriented or product oriented still report an inventory footnote that breaks out raw materials, things in process, manufacturing process, et cetera. They use different names for it. Rarely do they then add that to their balance sheet to do more granular work in terms of their financial ratios, as an example. Oftentimes PP&E, property, plant, and equipment, is broken out at a more granular level in the footnotes. Add that to the main statement. I'll give you an example because I'm trying to make this as practical as possible. I love to calculate useful lives and remaining useful lives statistics for each company, because companies do play games where they delay capital investments in some years. If they are really hurting in the income statement line, they will, and it's smeared, there's my word again, in the operating expense line, some of this stuff, because it's hidden in depreciation numbers or some other expense. They will delay maintenance CapEx, which can be inferred from the footnote on the PP&E, if in fact you put it in there. Anyway, if you calculate useful lives, you can see that, because that ought to be fairly consistent over time. If they have an average 10 years of property, plant, and equipment for this business model, and they haven't done acquisitions and they haven't changed their business model, if they're reinvesting to maintain, that useful life number ought to be fairly consistent over time. If you start to see it to go down, it means they're underinvesting, which means 1 year, they probably are going to have to overinvest. Ergo, earnings are going to miss or disappoint, and you're going to get hurt. So that's an example of where footnotes are extremely important.
Pensions, pension costs.
Oh, dear God.
You know, for those companies that have actually been around for, let's say, 30 or 40 years or longer, those are in the footnotes, aren't they, Jason?
Defined bennies. Aren't they fun?
Well, all right, just for the sake of clarity, right? GM, for quite a number of years now, has been arguably a pension plan with a little sidecar business. But how have people been looking at them? How have they been doing the work? Because now we have a call on cash flow that by law has to go somewhere other than Milton Friedman's shareholders. What are we doing with this? Anyways, I digress. Let's go to a couple of interesting bugaboos.
Hold on, two seconds though. You're absolutely right about defined bennies. My all-in work when I first was wrapping my arms around any company, right? So made it through the screens, been paying attention to it. Hey, that's an interesting business. I'm glad it, finally from a, first pass valuation look, PEG ratio, for example, which by the way, don't use PEG ratios. I know how most people work. Whatever, I'm looking at it comprehensively for the first time. I would look at return on invested capital, total capital. So defined benefit pension plans absolutely made it in there. I also capitalized operating leases to make sure that I had transparency in there. By the way, in terms of checking the accounts and the narratives, Skechers back in the day got a premium multiple from the market because people said that they were able to earn more per shoe than competitors. The ledger domain that they got away with was that they were treating as what should have been capital leases. They were writing off all their manufacturing as operating leases, which they should not have done. It should have been on the balance sheet, because there's no way if they lost those leases, they could stay in business. And once you did that, they actually had worse return on invested capital.
Once you find any business that is winning with some specific advantage versus their competitors, be skeptical. Just be skeptical. Why is it that they're competing and they're winning to such a degree differentiated from their competitors? It just doesn't. I'm not saying it's not possible, but you really need to investigate how have they reinvented the wheel?
Totally agree.
Because people aren't reinventing the wheel.
I totally agree. Like, people rarely stop to ask the most practical question of, is this credible?
So let's get to the bugaboos that I have.
Go, Michael, go.
Reg FD. So I think we have to take a moment, talk about Reg FD. And the second one, the markets today. And no, I'm not going to talk about Reddit. I'm not going to talk about GameStop. No, 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 no. We're not going there. However, markets today. So let's start with Reg FD. Jason, since Reg FD came into play, Regulation Fair Disclosure, which is a US based thing, because we may have some friends and listeners who are not in the US on this podcast or who may listen later. Jason, how did Reg FD impact the fundamental analysis that we're talking about on this podcast?
I think it homogenized it, but I would argue that for the people who are truly subtle, it improved your ability to deliver alpha, which is normally not the answer that's given. Most people say it hurt fundamental analysis. I think it improved the value add from other activities. So if you are sophisticated, for example, in your management interview techniques, oh my. And Michael, you and I, you've heard me talk about, and poorly, because I used to use this technique, and trying to formalize this stuff. Indirect context questioning is a way of asking questions that management doesn't know that they've necessarily disclosed an answer to you. So you've gotten the information, you've walked away with it. If you are sophisticated in that way, Reg FD helps you because you can be assured of what the common narrative is. So it makes more obvious what the alpha stakes are. So that's one response.
That's a quite an interesting perspective. And maybe when we get to some Q&A with our guests, maybe they want to pull on that thread a little bit more. There's no question it's homogenized. No question. The question is, what percent of analysis that is being done is of that subtle nature that you referenced, so that the homogenized doesn't level set everything. Again, I'm stuck in the US with this versus offering opportunity. And we maybe come back to that. My next bugaboo, Jason, does any of this still matter the way markets are working today?
Yes, and I'll tell you why. One, I think it is still possible to uncover, usually on the negative side. You don't usually, like what we're talking about is usually identifying companies to be eliminated from the portfolio or to be eliminated from consideration on the front end. So it's rare that you do FSA and you end up going, oh my God, I'm so glad I did this. I have a much better understanding of how they're better than any other company. It's usually, I don't want to buy, or I do want to sell the company. But yes is the answer, because that's still a worthwhile activity. There still is value add in that activity. It's rarer than it used to be, but here's why it's important. You said at the outset that wrapping your mind around the understanding of the business, the numbers with the narratives, is what's important. These numbers are very indicative of the behaviors and choices made by management some years prior, which was the point of return of the active manager.
They're the outcomes.
Exactly. These are the outcomes, the very last thing to be baked by the business when all things are said and done. The numbers are dead upon arrival. All financial statements are an autopsy. Like financial statement analysis is an autopsy, but the question as investors is a physical fitness question. I bring this up because once that's the numbers, those numbers are not going to be repeated again, right? There's no such thing as a future.
So we don't need financial analysts. We need to train a whole bunch of coroners.
I would say that many are corners, but they take as given that the rendering from the ME, let's just say there's a conflict of interest between the ME and the company, right? The medical examiner and the company. And that's why it's important to do this. What was the cause of death, right? How did these numbers get baked? What were the behaviors and habits? What was the diet, to take the analogy to its ridiculous extreme? What was the diet and exercise routine of the company that baked these numbers? Yeah, that's why we do it, is I think ultimately to wrap our arms around and affirm that what we're being told is accurate.
So Jason, you said yes, but what's interesting, it's really about what we should sell then out of our portfolio or what we should avoid ever investing in. So share with our audience what I know you and I've spoken about in the past. What is your attitude towards shorting? Because that would seem to be a great application for this level of insight.
It escapes my capability of shorting. Do I have good ideas for shorting? Sure, but shorting requires a different aptitude beyond just the fundamental analysis. You also have to get the timing correct. And because of the way margin accounts are done, you can be correct about your name a lot longer than, the market can be wrong about it a lot longer than you can stay solvent on your shorts. And I found the timing extremely difficult. Very rarely could I with certainty say, hey, this company is definitely playing games. Like the Crown Castle example I gave earlier, definitely playing games, goes to character, right? There's definitely a character issue there. Lehman Brothers was the main coverage of Crown Castle on the street. They never had any information about the weird goings on in the cash flow. It did eventually play out 3 years later. 3 years is a
Hmm.
long time to wait for that insight to
It
bear fruit.
is. It is. So, Jason, you just spoke what I think is an important truth for the industry at large that manages money. Shorting is a significant degree more difficult than being long in your portfolio. And it's just so interesting because over time, we've seen fewer and fewer and fewer hedge funds that short, whether it be exclusively or long short portfolios. There are nowhere near the numbers of managers doing this today than 10, 15, 20 years ago. So people have figured it out in a painful manner.
Yeah, and I'll add for our audience, on a previous podcast, we talked about a new product that I spent some years developing called deception and truth analysis. And one of the statistics from the work to develop those algorithms, which scan texts for their level of truthfulness or deceptiveness very rapidly, is 86.5% of statistics reported by companies is qualitative. It's verbal. It's in the words, and only 13.5% of the numbers. And
Oh, wait. So that's the guy who lost their keys in the field looking for the keys underneath the lamppost because that's the only place where there's light.
exactly, exactly. And because there are more and more people looking at that 13.5%, and because of Reg FD, it is harder to find your keys in that space. But by the way, if the keys were in fact dropped under a lamppost, you have to still look under the lamppost, right? So you don't get to ignore that 13.5% just because it's more difficult to find your keys there. But more to the point, with shorting, we did a piece of research in support of data, which is what that product is called, deception and truth analysis, which was we looked at all the biggest scandals of all time, and data was able to identify them. And this blew our minds, with an average lead time of 6.6 years. So
That's a long time to be short.
it's a very long time to be short. And
I would argue that even those who have shorted in the past or maybe still shorting today, it's never for that length of time.
never for that length of time. You'll never make money based on shorting, based on the insights from data. So the question is, and this is the question I've mulled for some time: why? Why 6.6 years? That doesn't make any sense.
Well,
And
oh no, it does.
well,
Oh, Jason,
say
it
more.
makes,
I know it makes sense too, but because I've thought about it. But why do you say so?
well, because we need coroners, not financial analysts. The numbers in the annual report and the other public documents, those are dead numbers. They come from decisions that were made many years before. They are the results. They are the outputs. They are the final arbiter, assuming that they have been stated correctly. They are the final arbiter on the decisions that management has made over the last 5 to 10 years. Or maybe
Exactly.
it's more 3 to 6 years because of how short-sighted. Oh, that's harsh. Maybe how short-term we have started to become.
Yeah, you nailed it. That's exactly my theory as well. As why 6.6 years is that the numbers are the outcomes based on behaviors which drove decisions. Who in those decisions, that set of decisions, took that long to bake into the current crop of numbers. Said another way, numbers are dead upon arrival, behaviors are living entities, and driving choices and decisions and behaviors still to this day. By the way, subject covered in Return to the Active Manager, I call it ABCD, attitudes, behaviors, choices, decisions. That's why we do the financial statement analysis, is to gain some insight into those things.
Just on a side note, this is why attribution work done on portfolio managers is not nearly as helpful as you think it is. You need to understand, how did they make those decisions initially? What were the inputs, not the outputs? And Jason and I have spoken about that many times on this podcast in the past. We have about 13 minutes left. You know, it's a rough number. Anybody who's listening, if you want to chat in a question
or your favorite mistake that analysts make, that's always fun too.
My favorite mistake that analysts make is they think they can shortcut the work. You can't shortcut the work. If you don't want to do the work, or you don't think you're capable of doing the work well, good, come to terms with either of those and don't shortcut it. Find somebody else who can do it better, or find another way that you think will work better within markets today. That's my biggest issue. People are too often mailing it in.
Totally. So if there are any questions, please unmute yourself and feel free to speak, or you can chat it in as well if you prefer.
Whichever you prefer, yeah. I hope we didn't make them afraid. Come on. We don't bite.
Well, I do know the following. All of those who joined us are skeptical thinkers, because they're all investors. Investors are skeptical thinkers. What did we get wrong? How's that?
I love that question. Give us feedback.
None offered.
Wow. Well, they haven't left us yet, but no feedback, no separate question or curiosity. Maybe they thought this was on balance, fair, and complete.
Don't know. But should we wrap things up and go on, or should we poll once more for questions? Should we beg? We can wrap. We'll wrap. All right.
I think wrap. If they don't have any questions or curiosities, listen, these are serious people. They care about footnotes.
Let's refund
and
their
one-time
time.
write-offs. They don't need us to blather on for too long.
Of course, we will refund their time to them so they can get busy looking at those footnotes and hand entering the data. So thank you so much for joining us. Our next From the Research Chair, many of you are new faces. We do this bi-weekly, so it's going to be in 2 weeks' time. It'll be on April the 15th, tax day here in the United States, though it's been deferred because of COVID. And thanks so much for joining us. And the replay will be on our YouTube channel, From the Research Chair.
And for what it is worth to all of you, effective today, all is well in the world once again, because it is opening day for Major League Baseball here in the US. So, cheers to all of you. Thank you for joining us today.
Bye, everyone.